Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Parker-Hannifin Corporation quarterly report. Parker-Hannifin Corporation offers a wide range of businesses and services across various industries. The company's product portfolio includes motion control systems and components such as vibration control, high-purity sealing, coatings, cryogenic valves and fittings, HVAC/R controls and monitoring, and fluid conveyance hose and tubing. In addition to these products, Parker-Hannifin also provides solutions for aerospace and defense applications, including avionics, electric and hydraulic braking systems, electromechanical actuators, engine exhaust systems and components, fire detection and suppression, flight control systems, fuel systems and components, and thermal management products. The company's services include process filtration solutions, engine filtration solutions, fluid condition monitoring, sensors and diagnostics, and power takeoffs. Parker-Hannifin sells its products to original equipment manufacturers, distributors, and through direct sales employees across various markets including North America, Europe, Asia-Pacific, and Latin America. The company operates through two segments: diversified industrial and aerospace systems. Parker-Hannifin Corp's significant stock price increase can be attributed to several key factors. The company's exceptional fiscal 2026 second quarter results were a major contributor, with record sales and adjusted earnings per share exceeding analyst expectations. This strong performance was driven by organic growth, heightened demand in the aerospace sector, and expanded operating margins. Furthermore, Parker-Hannifin raised its full-year fiscal 2026 guidance following the impressive second quarter results, increasing projections for reported sales growth, organic sales growth, and adjusted earnings per share. The company's strategic acquisition of Filtration Group Corporation for $9.25 billion is also expected to enhance its aftermarket business and expand its presence in key markets. Additionally, Parker-Hannifin reported a record consolidated backlog of $11.7 billion, with the aerospace segment alone reaching an unprecedented $8 billion. This indicates strong future revenue streams and has contributed to the company's positive outlook. Analysts have also maintained a moderate buy consensus rating for the stock, with several financial firms raising their price targets. The combination of these factors has collectively propelled Parker-Hannifin's stock price to new highs, reaching over $909 in early January 2026. The company's strong financial performance, optimistic future guidance, and strategic acquisition have all contributed to its significant stock price increase over the past year. Parker-Hannifin Corporation market capitalization of $121 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Parker-Hannifin Corporation holds a significant advantage in their industry. Parker-Hannifin Corporation trades at a higher price-to-earnings ratio of 35 times and a higher price-to-book ratio of 8.46 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be identified through various indicators. In the given summary, net sales increases by 9.3% and 6.7% for the 3 and 6 months ended December 31, 2025, respectively. The aerospace and defense market sales, particularly in North America, have also contributed to revenue growth. Within the aerospace systems segment, commercial original equipment manufacturer, OEM, and aftermarket sales have seen a significant increase. The diversified industrial segment has also experienced net sales growth of plus 6.5% in 2025 compared to 2024. Additionally, specific technology platforms such as motion systems, flow and process control, filtration, and engineered materials within this segment have driven revenue growth. The aerospace systems segment has seen a notable increase in net sales growth of plus 14.3% in 2025 compared to 2024. On the other hand, there are no explicit mentions of primary drivers of revenue decline. However, certain factors may impact revenue growth, including the proposed acquisition of Filtration Group and divestiture activity, which resulted in decreased net sales by approximately $38 million in Cone and $146 million in Hone. The company's net income experienced a mixed trend between Q4 2025 and YTD 2025. In Q4, net income decreased by $104 million from $949 million to $845 million. However, on a year-to-date basis, net income increased by $6 million from $1,647 million to $1,653 million. The profit margins also underwent some changes during this period. The gross margin improved slightly as the cost of sales, as a percentage of net sales, decreased from 63.7% to 62.6%. On the other hand, the operating margin remained relatively stable, with selling, general and administrative expenses, as a percentage of net sales, increasing from 16.5% to 16.2%. The changes in net income and profit margins can be attributed to several factors. The company's growth in North America and international businesses contributed significantly to its net sales growth. Additionally, the impact of acquisitions and currency exchange rates also played a role in boosting net sales. These factors likely influenced the fluctuations in net income and profit margins during this period. The company's financial performance indicates a strong ability to generate cash from its core operations. The data shows that the company has consistently produced positive operating cash flow over the past 2 years. In 2025, net cash provided by operating activities reached $1,644 million, while in 2024 it was $1,679 million. These figures demonstrate the company's efficiency in managing its day-to-day operations and converting profits into cash. This trend is a positive sign for investors and stakeholders, indicating that the company has a solid foundation to sustain its growth and meet its financial obligations. The company's debt level has experienced some fluctuations over the past year. According to the extracted summaries, total liabilities increased from $15,803 million to $16,191 million, indicating a moderate increase of approximately $388 million. Additionally, the total line of credit rose significantly from an unspecified amount in 2024 to $3.75 billion in August 2025. However, it is essential to note that interest expenses have shown some variation as well. The net interest expense for Q4 2025 was $106 million, a slight increase from $101 million in the same period of 2024. On the other hand, the year-to-date YTD interest expense for 2025 was $207 million, which is lower than the $214 million recorded in YTD 2024. A closer examination reveals that there has been a notable decrease in interest expenses over certain periods. For instance, the 3 months ended 2025 saw an interest expense of $106, representing a 50% drop from the 6 months ended 2024's interest expense of $214. Furthermore, the company experienced an increase in interest expenses due to a 100 basis point rise in near-term interest rates, resulting in an additional $24 million in expenses. In conclusion, while there have been some changes in both debt levels and interest expenses, they do not appear to be significant or drastic. The fluctuations are relatively moderate, indicating that the company's financial situation remains stable. The performance of various segments and regions within the company has been analyzed, revealing both positive and negative trends. In terms of segments, the diversified industrial segment stood out as a top performer in 2025 compared to 2024. With net sales growth of 6.6% over 3 months and 3% over 6 months, this segment demonstrated significant improvement. In contrast, the aerospace systems segment performed relatively flat, with no specific performance metrics mentioned. Regionally, North America was another strong performer in 2025 compared to 2024, with net sales growth of 3% over 3 months and 0% over 6 months. The Europe and Asia-Pacific regions also showed growth in 2025 compared to 2024. However, the international region was a standout, with net sales growth of 11.8% over 3 months and 7.5% over 6 months, as well as operating income growth of 22.2% over 3 months and 13.9% over 6 months. Overall, these results indicate that certain segments and regions within the company have made significant strides in 2025 compared to 2024, while others require further improvement. Management's outlook for the company is optimistic, with a focus on expanding into new business opportunities. These include aerospace, defense, industrial equipment, transportation, and energy sectors. They believe there are many avenues for profitable growth available, which will be pursued through strategic investments. To achieve this growth, management has prioritized capital expenditures in areas such as safety, productivity, and strategic investments. A target of 2.5% of sales for the remainder of fiscal 2026 is set, with a long-term goal of 2%. Additionally, the company will continue to pay quarterly cash dividends, increasing them annually. To return value to shareholders, management plans to utilize share repurchases without limitation on the number of shares that can be repurchased in a year. The company is also considering strategic acquisitions and divestitures to maintain strong finances. Overall, management's strategy aims to drive growth while maintaining financial stability. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $456 million in 2025, with a quarterly cash dividend of $1.80 per share declared on October 22, 2025, and paid on December 5, 2025. Additionally, the company has also engaged in share repurchases, with the board of directors approving an update to the number of shares available for repurchase on August 21, 2025. This demonstrates a commitment to returning value to shareholders through both cash dividends and strategic share buybacks. There are concerns about inventory buildup or supply chain disruption. The diversified industrial segment backlog has increased by $3.7 billion due to orders exceeding shipments, indicating a potential strain on production capacity. Furthermore, the day's supply of inventory on hand was 95 days at December 31, 2025, which is higher than the previous year's 89 days. This increase suggests that there may be an accumulation of inventory, which could lead to storage costs and reduced cash flow. Additionally, acquisition-related costs and amortization expense related to the step-up in inventory were mentioned on page 8, implying that the company has invested heavily in its inventory, which may not be generating sufficient returns. These factors collectively raise concerns about the potential for supply chain disruption and inventory buildup. That concludes the financial summary for Parker-Hannifin Corporation. Feel free to comment below, and I will be happy to answer them when possible.